The S&P 500, which is a US stock market index comprised of the top 500 companies in the United States of America, is without doubt my favourite investment. But it's not just my favourite investment, it's also the public's favourite investment too. In actual fact, out of the top 100 exchange-traded funds, the top 3 are S&P 500 trackers, with over $1.5 trillion in assets under management. But why exactly is the US stock market such a popular choice for investors? Well, let's discuss. One of the things that continues to impress me as a retail investor is the levels of innovation that have continued to take place over in the United States over many decades. We're going back slightly in time here, but I was watching a docuseries over on Disney Plus called The Imagineering Story just a couple of nights ago with my partner. And the docuseries is about Walt Disney and the development of the Disney theme parks. And on a bit of a side note, if you're a fan of the brand or a consumer of the brand, it's a super interesting watch. And to be honest, I was just kind of sat there in awe. It was kind of mental to kind of watch a bloke like Walt Disney have ideas so big and unique and have the ability to execute on them into today what stands as a multi-$100 billion organization. And I struggle running and building a bloody YouTube channel, let alone building theme parks all over the world. But what's quite staggering is that like even 60 years ago, Disney were doing things that are even impressive by today's standards. All of the technical and creative innovation was and still is phenomenal. Like, it just blows my mind at how like if you get the right people in a room together that are tasked with thinking outside of the box, exactly what can be achieved. From the development of animatronics to the creative staging of different rides, and even now with all of the latest tech, the rides that they're producing are unbelievably impressive. And to be honest, I personally think that's exactly where the US has stood out over the years, with Walt Disney just being one of those examples. We've also got Apple and the iPhone, Amazon and online retail, Tesla and the electric vehicle, Microsoft with the Windows operating system, Google with YouTube, Netflix with streaming services. Like, you could literally just continue to go on and on and on about the innovative companies over in the United States. And of course, companies situated in other countries have also innovated too. Some super innovative ones out there for sure, but just not on the same collective level. Now, what I mean by that, there are a couple of standout companies here and there based outside of the United States. But as a collective, remembering that we're investing in an index fund here, they just don't quite compare. If we take a look at the top 10 companies in the S&P 500 and then compare them to, let's say, the top 10 companies in the FTSE 100, the Euro Stock 60, the Nikkei 225. Like, in my opinion, those top few companies, which also generate quite a lot of the value, just don't quite stack up. And when I think about why I'm investing, well, I'm investing in the kind of companies that can generate future value. And the chances are those companies that can generate the most value for shareholders will inevitably be those companies that can innovate. And over in the United States, they have a pretty unprecedented track record. Right now, and arguably historically speaking too, the US has certainly been one of the best places for investors. And that really does show up quite clearly in what we're going to discuss next. One of the most appealing things about the S&P 500 as a retail investor is its long-term superior track record. We're all investing for one thing, and that's to grow our wealth over time. And you can only do that if you're investing in assets that also go up in value over time. Now, whilst returns have obviously fluctuated throughout history, with various different economic events taking place, this chart pretty much shows you all you need to know about the long-term performance of the S&P 500. To put some numbers on it, in the last 40 years alone, the S&P 500 has seen returns of 3,274%. Meaning if you'd invested just £10,000 back in 1984, today you'd be sat on a portfolio worth £327,400. But let me show you how those returns would stack up against some of the other world indexes that are as old as the S&P 500. As you can see, they just don't stack up as well from a return on investment standpoint. In actual fact, if you'd backed the top 100 companies in the UK over the past 40 years, well, your portfolio size would be 80% smaller than somebody else who would back the top 500 companies in the United States of America instead. And that is quite the eye-opening statistic. But it just goes to show how the UK market has particularly fell behind over the years. Now, we're missing quite a few of the other major world indexes because they simply weren't around at the time of 1984, 40 odd years ago. So now let's shorten our time horizon a little bit more and not just compare the longer term investment returns, but also look at the short-term investment returns too. So here are those returns on an annualized basis. Even from this data, the S&P 500 still stacks up as far better than all of the other major world indexes from a total return standpoint. Now, for context, let's say that you were to build an investment portfolio investing £500 a month, increasing that amount every single year by 2% to account for inflation, and you did that over 20 years, historically speaking, based on the returns that these major world indexes have provided. If we invested into an ETF that tracked these indexes individually, here is the returns that you would end up with. The numbers kind of speak for themselves once again, with the S&P 500 far out in the distance in terms of overall wealth creation. It's one of the reasons why my own investment portfolio has done so well. I've only been investing for the past 7 years or so, with the oldest part of my portfolio being my Vanguard UK portfolio, which is up well over 100%. And then more recently, over the past 4 years or so, my Trading 212 portfolio is up about 15%. Company value is derived from the number of shares in circulation multiplied by the company's share price. In investor speak, it's what's termed as market cap or market capitalization. Now, if we break down the components of this in a little bit more detail, company share price is typically what investors look at as a proxy for overall investment returns. But just to be clear, just because you have Apple shares trading at $220 a share and Berkshire Hathaway shares trading at $668,000 a share, it doesn't mean that Berkshire Hathaway, because they have a higher stock price, is the most valuable company, because obviously you have to take into consideration those number of shares in circulation, where Apple has over 15 billion shares, whilst Berkshire Hathaway has just 553,000 shares. But where does this underlying value of the S&P 500 come from? And how does it stack up against other global peers? Well, like with anything in investing, there's lots of different variables at play, but one of the biggest things is company earnings. In actual fact, earnings on a per share basis are directly correlated to that of stock price performance. The higher the collective earnings within the S&P 500, the higher that stock market index will rise, hence it being an important variable to pay attention to. Let's chat exactly what those earnings look like currently for the S&P 500. According to a report from FactSet that was recently published for Q2 2024, year-over-year earnings growth rate for the S&P 500 is 11.3%. That's pretty impressive, and it also marks the highest year-over-year growth rate recorded since Q4 2021, which was like peak market euphoria off the back of a pandemic. Whereas for the companies listed on the FTSE 100, well, their earnings are kind of heading in the wrong direction. The turquoise line on this chart is the FTSE 100 total earnings, and back in September of 2021 they were £139 billion, whereas right now they're £119 billion, which means in the last 3 years the FTSE 100 earnings have actually shrank by about 5% year over year. That level of trajectory is not good for investors looking to invest in the FTSE 100, because if those top 100 companies collectively aren't generating more wealth, then chances are they're not going to be generating more wealth for their shareholders either, or at least not as potentially as much as they could be compared to other global counterparts. And despite many analysts and journalists referencing that the UK equity market is currently cheap doesn't necessarily mean that it's a good thing. It's not quite the same as going down to the shopping centre and finding 20% off on the pair of trainers that you were going to buy anyway. In the investing world, cheap also shows a lack of investor appetite, and if there is a prolonged period where there is this lack of investor appetite, then the chances are that you're not going to see superior returns anytime soon. And that doesn't mean that things can't change. It just means for now, it's just not great. Our companies are so cheap, in fact, that the top 100 companies in the FTSE 100 are valued at just £2 trillion. That's less than the total value of Apple stock right now, which is valued at $3.4 trillion, which converted into pounds is about £2.5 trillion. So naturally, as an investor, I'm drawn towards the places that are generating the most value. And right now, the bulk of those wealth creators are firmly sat over in the United States. Nvidia being the most recent example of this. You've got mid-level management retiring as deca millionaires from literally just owning company stock in the past few years. Now, whilst obviously all of this is very appealing and hopefully kind of justifies reasons why I personally invest in the S&P 500, this would kind of be a little bit of a biased video if I only just focused on the positives. So now let me acknowledge some of the drawbacks that are also associated from investing in the S&P 500 too, and drawbacks that I'm certainly aware and conscious of within my own investment portfolio. Because in my view, there's no such thing as the perfect investment, and what may have looked good in the past might not look good in the future. So let's touch upon what some of those disadvantages are. Ironically, valuations can both be a benefit and a drawback. Good that market valuations are growing, but not good if it's relatively higher than that of global peers. Right now, the S&P 500 has a price to earnings ratio of 28.92. This means right now that investors are prepared to pay nearly $29 for every $1 in earnings that the S&P 500 collectively generates. But what exactly does that mean? Is that kind of a good thing or is it a bad thing? Well, compared to historical averages, it does make the US stock market right now fairly expensive. And when you do compare that to other global peers right now, the US stock market is actually by far the most expensive. You've got places like the UK, Germany, or even China that are trading at far smaller multiples. So I could certainly go elsewhere and get a little bit more bang for my buck. The only analogy that I could kind of think of to relate to all of this is it's like going to buy either a Ford Fiesta or a Ferrari. Fundamentally, both will get me to my end destination, but the Ford Fiesta will cost me a lot less. However, if I paid a little bit more and got the Ferrari, then I may just get there a little bit quicker. I hope that kind of makes sense, but let me know down in the comments if you guys have got a better analogy. The most obvious thing about the US stock market right now, and something that I'm most conscious of within my own investment portfolio, is the high levels of concentration risk. Whilst you're obviously investing in 500 different companies, actually only 7 of those companies generate the most of the value, along with generate most of the returns too. In actual fact, these 7 companies make up about 30% of the index's total value, meaning an adverse move in what's known as the Mag 7 or Magnificent 7, like we've seen in the past week or so with the top 3 in the form of Apple, Nvidia, and Microsoft selling off, it could potentially have a broader adverse impact on the S&P 500. So a bet on the S&P 500 is also for sure a bet on these top 7 companies continuing to perform well in the future as well. And as we all know, past performance isn't always indicative of future results. So just because we've seen good performance in the past doesn't necessarily go to say that we'll see it in the future too. I guess all of this opens up the question as to whether the S&P 500 is the only investment that we should be making, despite it being my own personal favourite. Should we be investing more broadly with a sprinkle of global diversification too? Well, I recently made a video where I kind of discussed all of this, which you can check out on this video next. With that being said, I'll see you over in the next one.